Welcome to The Explainer. So, if you're running a growing business, you're probably intimately familiar with the ultimate operational catch-22. To grow your revenue, you got to expand your capacity. But to expand your capacity, well, you need heavy, highly specialized, and incredibly expensive equipment. And if you just pay cash for that equipment, you drain the very lifeblood that keeps your daily operations afloat. It's a totally universal business problem. How on earth do you finance growth without suffocating your current cash reserves?
Okay, let's dive into this. For small and medium enterprise owners, and especially owner-operators right here in Ontario who are looking to scale, this isn't just some theoretical accounting question. It's literally the reality of surviving in a hyper-competitive market. Whether you're eyeing a brand new CNC milling machine or an entire fleet of refrigerated trailers, figuring out the financial mechanics of getting that asset is just as crucial as knowing how to operate the machinery itself. To give you the full picture, here's our roadmap for today. We'll quickly cover the capital crunch, what is a finance lease, the accounting impact, industry applications in Ontario, and finally, overcoming credit hurdles. Let's get started.
Section 1. What is a finance lease? Let's explore the core financial mechanics.
A finance lease, which you might also hear called the capital lease or a sales lease in the industry, is a very specific type of commercial arrangement. Basically, the finance company or lender acts as the legal owner of the asset for the length of the lease. But you, the lessee, maintain complete operating control over it. The equipment sits right there on your shop floor or in your yard. And, more importantly, you take on a massive share of the economic risks and returns tied to that asset's value over time. The transaction itself is highly structured, but mechanically pretty straightforward. First, you, the business owner, pick out the exact piece of equipment or software you need. Second, the lessor, the finance company, actually goes out and buys that specific asset. Third, you get full use of it while paying a series of regular rental installments, which covers the cost of the asset plus their interest. And finally, and this is a key feature of a finance lease, you usually have the option to take full ownership at the end of the term, maybe by making a final rental payment or paying a bargain purchase price.
Section 2. The accounting impact. Let's shift from the physical transaction to how these leases actually behave on paper. We really have to contrast a finance lease with an operating lease here, because a finance lease is capitalized. It actively increases both the assets and the liabilities on your company's balance sheet. Your working capital stays exactly the same, but your debt-to-equity ratio goes up, which naturally creates additional leverage. In plain English, the expenses are split between interest and principal, acting a whole lot like a standard loan. Operating leases, on the other hand, historically didn't recognize those lease obligations in the same way, which could sometimes paint an understated picture of a company's leverage.
Let's de-jargon the accounting standards for a second. Under International Financial Reporting Standards, specifically IFRS 16, there are 5 main criteria to look out for. First, does ownership transfer by the end of the term? Second, is there a bargain purchase option? Third, does the lease term cover the major part of the asset's economic life? Fourth, do the present value payments amount to substantially all of the asset's fair value? And finally, is the asset so specialized that only you, the lessee, can use it without major modifications? If any of those ring true, you are definitely looking at a finance lease.
So, the crucial point to take away is this. Regardless of the specific checkboxes, the ultimate deciding factor in the accounting world is whether substantially all the risks and rewards of ownership are transferred to you, the lessee. If you're the one bearing the risk of the machine breaking down, but you're also reaping the reward of its full productive capacity, well, the accountants basically view you, for all practical purposes, as the true owner.
Section 3. Industry applications in Ontario. Let's move from accounting theory into some highly practical, localized examples right here in Canada.
Take the manufacturing sector, for example. Say you're a machine shop looking to upgrade. Toronto-based CIK Capital uses these exact financial instruments to help you get heavy-duty gear like CNC milling machines, routers, and laser cutters. Because they totally understand that time is money, their streamlined process often gets you approved in just 24 to 48 hours. They offer really flexible terms ranging from 12 to 60 months, and many businesses can even qualify for zero down payment. This perfectly highlights our core theme. By financing the machine, you preserve your hard cash for things you simply can't easily finance, like buying raw inventory or hiring top talent.
Now, if we look at the logistics and transportation sector, the scale gets even bigger. Consider 10 Leasing. They operate an incredibly expansive network of over 45 service locations across North America, including a major strategic hub right here in Cambridge, Ontario.
For logistics fleets servicing the bustling Ontario supply chain, draining cash to buy trailers outright is rarely the smartest move.
Through partners like 10 Leasing, operators can get their hands on a huge array of tangible assets. We're talking standard dry van trailers, temperature-controlled refrigerated trailers, robust flatbeds for those specialized loads, and even the chassis and yard tractors you absolutely need to move containers around a freight yard efficiently.
And this really shows that while we're talking about high-level B2B finance, this is still ultimately a relationship business. A client of 10 Leasing, Mike F., specifically noted their friendly and knowledgeable staff, vast trailer inventory, amazing service, and extremely competitive pricing. Having a financial and equipment partner who truly understands what you need on the ground is just as vital as the numbers on the lease agreement. This kind of deep industry understanding is absolutely critical for highly specialized equipment. Take a look at ShredTech, a company headquartered in Cambridge that actually manufactures mobile document destruction trucks. They partner with specialized lending providers who deeply understand the incredibly niche document destruction industry. You see, these aren't just generic loans. They are tailored financing options built specifically for the unique revenue models of both startup and established mobile shredding businesses.
Section 4. Overcoming credit hurdles. So what happens when traditional banks say no? Let's tackle that final, stressful hurdle.
In fiercely competitive markets like the Greater Toronto Area, owner-operators often face immense hurdles if their historic credit score is less than perfect. But specialized lenders like Canadian Equipment Financing take a totally different approach to bad credit or subprime financing. Instead of just staring at a 3-digit credit score, their non-prime lender network looks at compensating factors. They evaluate the actual tangible value of the specific truck you're buying. They look at your dedicated shipper contracts and the revenue you are guaranteed to generate. They factor in your personal driving experience and your ability to bring a strong down payment to the table. Essentially, they finance the potential of the business, not just the history of the borrower.
And it's really important to mention that this subprime and alternative financing isn't exclusively for Toronto drayage fleets. It heavily supports the incredibly diverse industrial base right along the Kitchener-Waterloo and Cambridge corridor. Whether it's an automotive supplier needing production gear or a regional distributor needing delivery vehicles, alternative financing ensures that credit hurdles don't permanently park a growing business's operations.
So we've walked through the mechanics of finance leases, the accounting implications, and exactly how localized industries across Ontario are using these tools to bypass traditional credit roadblocks and acquire crucial assets. Which leaves us with one final, absolutely essential question for you to ponder regarding your own operations. Are you leveraging the right financial mechanics to scale your equipment without sacrificing your cash flow? Thank you so much for joining me for this explainer. Keep learning and keep growing.